Welcome to today's video. My name is Andrew Kuhn with Focus Compounding. Thank you so much for tuning in. If you're not familiar with myself, definitely check out our podcast, Focus Compounding, on your iTunes app or Podbean. We have, I think, over 107 different episodes, all on investing topics, so it's a lot of fun. My partner Geoff Gannon and I, tons of hours of content, so definitely be able to check that out. Be sure to check that out. In today's video, we're going to be going over Moat. And in the last video, we went over durability, and I'm going to leave this checklist up here. Geoff and I think through this every single time we're learning about a new company, and it's put out in this order purposely. So we have durability, moat, quality, capital allocation, value, growth, misjudgment, and appraisal. And the way that it's laid out is if you are studying a business and you can't figure out what's durable about it, you probably shouldn't care about the moat, right? Or the quality, the capital allocation, etc. Put in the do hard pile and go on to the next business, right? But if you could figure out the durability, the moat, and everything else, and you could come up with an appraisal, then maybe it's an interesting idea, right? And then we'll put it on our watch list. It's a business that we like and would like to potentially own in the future. So don't get discouraged if you're studying a business and you don't feel like you can figure out all of these things and feel pretty comfortable about it. Just go to the next business. There's a ton of public companies, and you don't need to know everything about every single one. So in the last video, when we went over durability, we were outlining it with Parks America, which is a company that we do not own, but it's a company that I definitely encourage everyone to study, especially if you are a private investor yourself for your own personal account. It's a very small company, $10.4 million market cap. It's very illiquid, it's very overlooked, and it's an interesting company to study. But Parks America, as I said in the last video, they own 2 wild animal safaris. That's actually their business. Think about a drive-through or a walk-through zoo. They operate in Georgia and Missouri. And I think a lot of their moat comes from the location of their assets, that and including the operating leverage that the business has. If a rational person were to want to start up their own animal wild safari, they wouldn't go probably within hundreds of miles of these 2 parks, because that would just eat away at both companies. The way that we think about moat is a lot of people, I think incorrectly in my opinion, they look at a business that has a very high return on capital and they say that company has a moat, right? And I think they're right, but the way that I think about it is it's the tangible and intangible qualities of a business that allow it to have that high return on capital, right? Because it's the nature of capitalism. Whenever a business does exceptionally well, no matter what, come hell or high water, you're going to have competition that comes in, right? What happened when Uber started doing great? Up came Lyft. DoorDash was, I think, one of the first ones to do delivery, food. And then now you have Uber Eats, you have Postmates, you have Favor, you have a bunch of them, right? Whenever a business does great, there's always going to be competition. So we want a business that has a very clear and defined and wide moat that's going to allow it to continue to produce tons of cash flow, high returns on capital, that's going to allow them to fight off that competition. And there's many different forms of moats, and we can just kind of go through them. High switching costs. Think about banks, credit cards. How often do people switch from these things? It's a hassle to switch, so there's a lot of inertia that's involved. That could be a source of moat for businesses. Patents, obviously if you're legally protected from competition, that's great. Technology, software companies, pretty much every company I would say has some sort of patent, and that's great. Contracts, Geoff always talks about BWX Technologies, the nuclear reactor company that had a long-term contract with the government. Obviously that's great. Network effects, you think about eBay. Buyers go to eBay because they know there's a lot of sellers there. And on the other end of the spectrum, a lot of sellers go to eBay because they know a lot of buyers are there. So it creates this positive feedback loop for the company. Shelf space. We actually wrote about that a couple years ago when we wrote about Hostess Brands. They own Twinkie. It was a business that actually went into bankruptcy, but was bought out of bankruptcy by a private equity guy, Dean Metropolis, who's known as Mr. Shelf Space. He's known for taking these brands that are having issues, revamping them, changing the ingredients, giving them more shelf space, and then flipping them. He's actually sort of in the process of doing that. He actually just, I believe, announced a secondary offering for his shares, I think last Thursday or last Friday, so that's kind of interesting. But we don't own it, but that's definitely a form of moat. Brand recognition, you think about Nike, you think about Under Armour. Consumers and customers go with brands that they can and will trust. There's a lot of social proof, there's a lot of confirmation bias, there's a lot of psychological phenomena that go into that. Economies of scale, logistics, You can think of Costco, Amazon, Walmart, both companies with massive economies of scale and logistics. It would be very hard for a new business to start up a massive warehouse like a Costco or Sam's Club or Walmart and compete against what they already have. The replacement value of that is very high. Location, location, location. If you think about real estate, obviously that's the number one rule. Regulatory, that is great. What comes to mind when I think about that is VeriSign Inc., the domain registry company for .com and .net. I can't remember if it was .com or .net, but I believe it was .net. Like 2 or 3 years ago, they extended their contract, I think for another 7 years, where they were the only company that is allowed to register .com or .net. So obviously that is great for the business. High barriers to entry, again, kind of spoke about that. With the replacement value of businesses, that's a form of moat, some sort of technical skill, reputation. Amazon or Apple, they have very high amounts of reputation, so they probably can't trust us. Certain startups or sort of fly-by-the-night types of companies. You could even take this a little bit further, and there's intangible qualities of business, intellectual property, and stuff like that. But your goal as an investor, I would say, is to find a business that is trading in the market as if it doesn't have a high and a wide moat, right, or a deep and a wide moat, right? I would say that a normal business in today's market that's predictable, it's a great business, and it has a high returns on capital because of its great moat, should probably trade in the market at 25 to 30 times earnings. Your goal as an investor is to find a business that has all those things, that's probably trading at 10 to 15 times, right? It has under appreciation by the market. And those are the types of companies that you should look for. So I want to thank you so much for watching me today. Speak a little bit about Moat. If you aren't familiar with our work, definitely go to our podcast where we go in way more detail on all of these things. I think it's episode 19. We actually title it All About Moats, and we dedicated, I think, an hour to talking about everything you'd ever want to know about moats. But anyways, I want to thank you so much for tuning in with me here today. If you aren't subscribed here, definitely hit that subscribe button and thumbs this video up. Follow me on Twitter, where I post all about a bunch of different types of content in relation to investing, and it's a lot of fun, so definitely check me out there. I want to thank everybody so much for tuning in, and I will see you in the next video.